Well, equities declined last week for the second week in a row as haven demand drove treasuries higher across the curve and also saw the dollar trade to its best week since last November. This week, lingering tariff and geopolitical risk likely to dominate financial markets, but we've also got a pivotal slate of US data up ahead as well, including, of course, the non-farm payrolls numbers on Friday, plus the ECB, who are set for a 25 basis point cut on Thursday, despite some hotter than expected inflation figures earlier this morning. Plenty for myself and Ryan Littlestone to discuss on the trade-off this week, live, of course, and absolutely anything can happen. So without further ado, let's crack on with the show. Good afternoon to all our viewers. It is another busy week in the financial markets. Joining me as always to try and make sense of everything that's going on is my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. And Ryan, having put up with me for, well, 100 episodes now, I think you deserve some sort of a medal, mate. Good afternoon to you.
Good afternoon, mate. Well, don't know about a medal, but it's not really a birthday, but I've got a cake with a candle in it for us, and just to celebrate our 100th show. And it's it's been a pleasure, mate, to be alongside you and doing what we do. So happy 100th show.
Indeed. Well, cheers to that. All I've got is water, sadly. No drinking on the job over here, and no candles in cakes either. It's a fire hazard. I'm afraid.
We're off already. Got the cards ready as well. So all prepared for this live event.
Well, let's, without further ado, get into things and get chatting about that payrolls number on Friday. Right, so jobs day is up ahead, of course, Friday being the first Friday of March. And I think the labour market report, as I said at the bottom there, it's the most important jobs report since the last one, but slightly tongue-in-cheek. But I do think markets are getting a little bit jittery about the state of the US economy at the moment. I know we discussed this last week, mate, but we've had a run of soft-ish data points out of the States. The S&P Services PMI was at a 25-month low. Consumer sentiment per the University of Michigan survey has tumbled. Consumer confidence from the Conference Board last week, that notched its biggest month-on-month decline since August of 2021. So it's not exactly the most positive backdrop going into the payrolls number this week. And I think the market is certainly not in any mood to forgive any downside data surprises. Although I guess the biggest question is how the hell you're going to rig your sweepstake to stop me from winning this time around, isn't it?
Do you want another yellow? It's here. I've got it ready.
You're going to be doing the 101st episode on your own at this point, mate. But anyway, as for the slightly more serious stuff, headline non-farm payrolls are seen rising by 160,000 in the month of February. That would be a modest rebound from the 143k that we saw in January, and largely as a result of some of the weather-related weakness from Jan being unwound. As is always the case, the range of estimates is very, very wide, between 100,000 on the downside and 300,000 on the upside, which is quite frankly farcical, but it is important to note that the February figures will be too early for the bulk of the impact of these federal layoffs that Trump and Musk have brought in to be accounted for. That will probably come in the March data. Unemployment, meanwhile, seen holding steady at 4%, with participation also expected to have held steady at 62.6%. And last but by no means least, average hourly earnings. Growth there is set to cool to 0.3% on the month from a prior 0.5%. That will almost all be due to the length of the work week extending once more, again, as some of the weather impact falls out of the data. Now, in terms of where markets sit at the moment, the OIS curve prices about 62, 63 basis points worth of cuts by year end. That's up from about 35 basis points a fortnight ago, which helps to show how jittery market participants are. And I think the best way to kind of look at that pricing is obviously the Fed in the December dot plot said they deliver 50 basis points of cuts. So the market has fully discounted that. It just has an extra 15 basis points in there for good measure, basically a premium of something going wrong. To be honest, it feels like the payrolls number this week is maybe a little bit binary. If we get a decent report, then the growth scare's over, or at least postponed and for another month. But if we get a soft payrolls number. And certainly if we get soft ISM figures before that, then batten down the hatches, I think, mate.
Yeah, absolutely. And we've been saying it for a while, what's it going to take for the market to get more hawkish about the Fed? It's going to be really strong data, really hot inflation, things like that. So the risk has always been that we knew the Fed were in pause mode, the market jumping around, whether it's June, September, December with the next rate cut and how many they're going to be. So the real big risk is that data does soften, because then the market's really going to reel in that time when they think the Fed's going to cut. We get a really bad number on Friday. Indeed, even if we start getting them from the ISM reports, we're probably going to start seeing March getting priced again, or April. So it's really, we get a bigger move on bad news than we would do on good news. That's the way to look at it for this. As for the jobs, what they're going to do themselves, I think the market's extrapolating maybe a bit too much from some of these other softer data points, and saying, well, if we're seeing a softness in the S&P PMI, well, the jobs market's going to be next, and that's going to collapse, and we will be waiting for the jobs market to collapse for the last 2-3 years. So, that's
probably for about 100 episodes, mate, to be honest.
Exactly. So, it's going to happen at some point, but is this week the week? Who knows? If it happens, it happens. But it probably is too early for those government numbers to come in, but just in case we do get a wobbly one, they give us the breakdown between manufacturing and government payrolls and private payrolls. So just make sure you look at that number just in case there is something wobbly in there. Because if you get a 100k print, but 70,000 of those was a negative government number, then the market's probably going to knock that off and bounce back on the back of it. But I wouldn't be surprised, a soft number. We're really bringing forward those rate cuts and how many we get.
Yes, I agree. I think the market would pounce on that. And just to make things even spicier than they already are, Fed Chair Powell is going to be speaking 4 hours after the jobs numbers drop on Friday evening here in the City of London, giving his view on exactly what's going on. So do bear that in mind if you are trading into the weekend. Anyway, speaking of things getting spicy, let's get over to Japan.
Yeah, things are really going to crank up this month. March is one of the most important times of the year for Japan and trade in Japan. It's the last month of the fiscal year, and given the scenario we're in right now, it's going to mean big things for the yen. Now, I want to list a few things to look out for over the next few weeks. First thing to look for is repatriation flows. This is a time when overseas profits are often repatriated back to Japan for year end, so settle tax bills and whatnot. So that could mean potential yen buying. That means the fixes are going to be important. Now, the Japanese fix, the Tokyo fix, is at 10 to 1 UK time in the morning. I think that's 16:50 local time. But you also need to watch the Kotobi days, and those are the multiples of 5, so the 5th, the 10th, the 15th, 20th, so on, because those fixed days are the most important in Japan. That's when they like to do things, and those can be the busier fixes. Secondly, we've got the good old Japanese whales. These are the big government pension funds and insurers that tend to set out their investing objectives for the new fiscal year at this time. Now, that can have implications for both FX and different assets. And in this scenario at the moment, where we've got Japanese yields, ratcheting higher on the back of all these BOJ rate hikes, the focus this year is going to be on whether they decide to maybe tilt the balance between foreign investments and domestic investments. So if that's the case, then that's a bit more FX neutral, but it could mean that we see them selling out of assets in other countries' jurisdictions. Thirdly, we've got the wage negotiations. They're going to be coming up right across from March all the way through to April. And we're going to hear more and more from the various unions and the different sectors in Japan and what they're looking for in wage talks. We've already had the largest union, Rengo, looking for somewhere around the 5% mark for wages this year. And then we've got the Japanese Council of Metal Workers, JCM, looking for upwards of 14%. Now, that might be split across bonuses and full-time pay and part-time and whatnot. So it's a heavy number, but those are sort of numbers we're looking at the moment. So strong numbers again this year will have the BOJ thinking about hikes again, and the government will be really happy with that. So a very, very busy period for the yen, amid obviously everything else that's going on in risk in general. So it's going to be a month to watch, mate.
Indeed. Well, actually, you're going to be watching it on your own. If there's a 14% pay rise on offer, I'm going to go and become a metal worker in Japan, I think. That sounds like a bloody good deal for them. In all seriousness, though, you're absolutely right. March and early April is a very, very busy time of year for Japan. And I think normally you might be sat here going, is there an opportunity? Is this going to bring a greater degree of vol? But actually, I think this year you're probably going, this could be a nightmare, because there's already more than enough going on, particularly in terms of geopolitics, which is obviously driving haven demand for the yen, regional trade, and also everything else that's going on. You then say chuck these three factors in the mix too, and potentially a more hawkish stance from the BOJ. It could just become an absolute nightmare. So I think once again this speaks to the importance of risk management and keeping positions nice and tight, particularly if you're going to be holding them overnight through those key Tokyo fixes, which I'm sure you will be getting up nice and early for.
Of course not.
Well, I knew you wouldn't be, but I thought I'd try nonetheless.
Well, maybe you could try getting up for once in your life and covering some of these things.
Oh, mate, the way things are going at the minute, I'm up at 1 o'clock most nights anyway, in the middle of the night.
There we go. Let me get, where's that little fiddle I need? That's the only thing I forgot to get, my little fiddle. I knew that would be
matron. Shall we move on?
Yes, we better.
Because there's an ECB meeting this week coming all the way back over to Europe. The ECB will, of course, deliver a 25 basis point cut on Thursday. That will lower the deposit rate to 2.5%, and the Eurozone OAS curve is fully discounting such a move. Now, 2.5% is a very important number in the Eurozone because it is the very top end of where the ECB's estimates of where the neutral rate is. Now, of course, I will just caveat this by saying that the ECB spent God knows how many hours and God knows how much cash coming up with a study as to where neutral is, published the study, and then about 20 policymakers have said this is of no use to actually determining policy. But despite all of that shambles, getting rates back to 2.5% naturally leads to questions as to how much further the easing cycle may go. Now, before we get to that, the ECB's policy guidance is going to be unchanged. They're going to stick to this data dependency, setting policy meeting by meeting, not making any pre-commitment to a particular rate path. The key question really comes down to one word, and that is whether the ECB continue to describe their policy stance as restrictive. President Lagarde thinks it is. Governing Council member and exec board member Isabel Schnabel thinks it isn't. We're back to France versus Germany on the ECB, like the good old days. Now, my base case is that they discuss whether policy is restrictive or not, but they keep that label for now. And that in turn would keep the prospect of further rate cuts on the table, potentially at every meeting, as we have seen. But I think if they were to ditch the label that policy is restrictive, it would probably send a bit of an unwanted hawkish signal right now. Yes, we had that hotter than expected inflation data a little bit earlier on today, but we still see core prices coming back down towards 2%. There was a decent drop in services CPI as well. And I think also you can't forget the ridiculous number of downside growth risks that the Eurozone continues to face. Germany has no government. France has no effective government. There's obviously plenty of geopolitical risk out there as well. And the Chinese economy is still showing little to nothing in terms of significant economic recovery. But having said that, and of course do watch the press conference and also potential post-meeting sources stories for clarity on those deliberations, the ECB is, dare I say, becoming interesting once more, because as we get closer to neutral, which is could be as low as 1.75% or as high as 2.5%, the discussion over the pace and the number of further cuts that policymakers should deliver is going to ramp up. And also there's the matter of, do they go below neutral later in the summer and actually try to stimulate the economy? Now, if you look at what markets are pricing, we've got about 80 basis points of cuts in the curve, which feels about right, maybe a little bit underdone. I personally, I don't know whether you disagree with this, Ryan, but I still think that the euro has now got past this peak pessimism stage. And the big issue is the ridiculous amount of geopolitical noise that's going on. And the euro, if some of that can dissipate, then maybe a little bit more euro upside could be on the cards.
Yeah, I think that's the case. the ECB are getting themselves into a bit of a Bank of England situation, i.e. between a rock and a hard place.
That's not anyone you want to follow.
You know, on one hand, we've still got sticky inflation, and that is the ECB's mandate. It's not jobs, it's not growth, it's stable prices at or below 2%. They've not got that. So on that side of things, they still need to stay restrictive. On the other side, you've got a ton of economic weakness still in many countries. There are a few outliers like Spain and perhaps Italy, but as for the big ones, Germany, France and the like, they're still looking pretty weak. So on that side, you would think that they need to start getting a bit stimulative with their monetary policy. And then on the other side, you've got what's coming with all this geopolitics, the potential stuff with the Ukraine, tons of money now going into defence that they've got to find a magic money tree for, which, as we know, that means more borrowing. And they've got to do that borrowing on top of weak economies. So how are they going to pay it all back? So they then face investors who buy government bonds looking at taking a bit of a premium. So then you're going to have higher yields coming in as well. So it's becoming a very, very big mess. Overall, I think whatever happens, they're going to have to take rates below neutral. I've been saying it pretty much for the last 6-8 months. They will take rates below neutral. I wouldn't be surprised if we're heading towards somewhere close to zero again, unless we see the economy turn around, unless we see a resolution in Ukraine. That doesn't mean they have to pump billions and billions more into it. What that means for the euro, again, I agree with what you're saying. If we get some of this geopolitical risk subsiding, then there's potential upside for the euro. But then, you know, all the chickens come home to roost, and then we get back to the fundamentals. And I'm not going to be a buyer of the euro on those fundamentals. So, yeah, I think rates are going to come down. The euro is going to come down with it. For this meeting, yeah, it's going to be the usual bum fight between your Schnables and the Lagardes. It was actually worked out, I think, that it was Schnabel who did the sources piece after the last ECB meeting, because that sources piece was that they may remove the restrictive moniker, if you like, from the statement. So I think that all ties together. And yeah, I think for this meeting, you're going to trade it for what it is at the time, but longer term, it's a different kettle of fish.
Yeah, no, I think I would agree with that. I did, going slightly off topic, sadly, I can't claim credit for this, but I did see some in a research note the other day that the Eurozone at the moment is the revenge of the pigs. If anyone remembers the sovereign debt crisis, when you had Portugal, Ireland, Italy, Greece and Spain were effectively thrown under the bus. Well, Greece is now issuing debt at a lower yield than France. Italy and Spain are about the only countries in the Eurozone that are growing. Portugal seems to be doing all right, and Ireland is running about a 20 billion euro budget surplus. Meanwhile, France and Germany continue to stumble. So, yeah, the tables have very much turned in the Eurozone. And speaking of turning tables, shall we talk about what happened in the Oval Office on Friday?
Oh, we have to. I was really hoping for a week off giving Trump dates, but that's obviously wishful thinking, eh?
Where are my yellow cars?
You're not getting mine. Mine are safely here on my desk, so you're not having them. Anyway, last week we had this discussion on the show. I said my hopes for a resolution in the Ukraine situation were dwindling, and they pretty much ended up getting wiped out altogether on Friday night after that Trump-Zelensky meeting. I'm not going to comment on how all that went down, because we're here for trading perspectives, not political ones. But as we saw in the markets, risk got absolutely clattered, really because the market was thinking, well, that's the US out of the whole game now in terms of getting peace. And that's where we finished the week, with risk not looking too good. Now, whether something can be rescued between the US and Ukraine remains to be seen. There's been a few comments today that, particularly from Zelensky's side, that, you know, a minerals deal is perhaps still on the table and achievable. But really, it's all been brushed into Europe's lap, which, quite frankly, is where it should have been in the first place. Now, those headlines are going to keep coming. And then we also have the tariff deadline tomorrow for Canada, Mexico and China. And right now, it looks like the China tariffs are going to happen, whatever comes about. Now, for Canada, things are still probably a bit 50-50 on whether a deal is done. In the meantime, Mexico, I've been saying for the last couple of weeks, it still looks like they're in the best place to get a deal done, or at least get a can kick on the deadline. So for the Chinese yuan and the Canadian dollar, I think there's still two-sided risks on a deal or no deal confirmation. And if we do get those confirmations, you're going to see further weakness in those pairs. But for the Mexican peso, there's obviously still some no deal risk there. But I did get short after my play of the day last week, up in the 2050s, and I've sort of been jobbing it between 2050s, 2040s. And I'm happy to stay that way and stay short and add on any rallies for that side, because I still think a deal is going to be done, or is easier to achieve there than in the other two.
Good stuff. Yeah, I mean, again, I don't want to dwell on the shambles that for too long. I think the nub of the situation is that none of the three people involved, Trump, Vance, or Zelensky, came out of that looking particularly good. But your conclusion is the right one, that sadly a ceasefire or some sort of agreement to end the fighting there does look further away than it was, which is clearly not an outcome that anyone would be seeking. I think on trade, here we go again in terms of is Trump's bark worse than his bite? And again, I think your assessment is pretty much spot on. And it was interesting on Friday, and it did go a little bit under the radar, not just because I was sat in the pub, but because while there was this fight going on in the White House, the Treasury Secretary, Scott Bessent, said something very interesting, which was that the United States want Canada and Mexico to match their tariffs on China, which was, I think, probably saying the quiet part out loud, because Trump's been running around saying this is all about the flow of drugs, this is all about immigration. It's actually not. It's just about making the entirety of North America as hawkish as each other. And on that front, Mexico have sounded a lot more receptive to the idea of upping their levies on Chinese imports than Canada have. And I think the reason for that is political, to be completely honest. Canada is months away from an election. They will elect a new leader of the Liberal Party this weekend, and then have an election pretty much straight after that for the new Prime Minister. And the Liberal Party have undergone a sort of Lazarus-like recovery in opinion polling in Canada, basically by standing up to Trump. Now, if you're Justin Trudeau, or if you're Mark Carney, my favourite person, who's the likely man to replace him, do you want to throw away that potential political advantage and cave into the US's demands in terms of Chinese tariffs? So I think the loonie is probably a greater risk of downside than the Mexican peso, just in terms of the prospects of a deal being done. But I've got to be honest, I'm glad we're doing this live, because those comments could be out of date in about 5 minutes if Trump decides to get on his social media network.
Yeah, I'm surprised we haven't got the old Truth Social running in the corner. But I agree with you. But this is got to remember, this is still only part one tariffs. Okay, this is on immigration and drugs and whatnot. And Trump's bugbear is that a lot of this comes through Mexico and Canada from China. That's why he wants them to reciprocate on the China tariffs, just to try and stop that pathway into the US. Whether he succeeds or not is another matter. But I see for the one, I think it doesn't matter. They're getting tariffs, whatever happens tomorrow or whenever. Canada, there's two positive paths. One is a deal, obviously. One is a deadline kick the can, just because they've made some progress. The only negative is obviously no deal. So that's what I see for the loonie. But otherwise, we're going to be glued to the screens tomorrow.
Sorry, this kick the can, deal or no deal, I'm getting terrible PTSD from the Brexit days here. So let's move on to our plays of the day. Right, couple of plays of the day, and then we will move on to some questions. So if you do have a question, and the question is not when Arsenal are going to win the league, then please do pop that into the little chat box, and we can get to those in a while. Before that, though, I want to have a look at the bond market, and particularly the 2-year Treasury, which is trading 5 basis points higher than it was when I made this chart earlier on. But nonetheless, I think the point still stands because we did trade beneath 4% on the 2-year on Friday, with yields falling to their lowest level since the autumn of last year. Now, of course, we've come a pretty long way in a pretty short space of time. We're about 40 basis points below the year-to-date highs that we just saw prior to Inauguration Day. But I do think that the risk-reward continues to favour bond bulls here, or lower yields effectively. And the argument really comes down to as simple as this. It is pretty easy to envisage scenarios, as we were discussing right at the start of the show, where the Fed could deliver 50 or 100 or 150 basis points worth of cuts this year. But unless your name is Richard Matthews, and I'm not sure if he's watching, it's very, very difficult to imagine them raising rates by the similar magnitude. And of course, you've got to bear in mind that when the 2-year is trading at 4%, we're still about 100, 120 basis points above where you would consider a neutral Fed funds rate to be. Plus, of course, you are dealing with an administration in the White House who is actively trying to engineer lower Treasury yields. And there's some rumours of the Fed wanting to bring quantitative tightening to a halt as well, particularly if the debt limit issue comes to a head. So potential for a bit of profit taking in the short term from the bulls, given that we've come down to this psychological big figure 4% level. But even when we get past that, and certainly if we get some softer than expected figures this week, then I think the bond bulls should continue to hold the upper hand. Now, Ryan, you're looking at Euro sterling, I believe.
Yeah, very much so. One of my old favourites, and looking for a similar to play, something I spoke about the latter part of last year, because this is a pair I do trade quite regularly, and we're back down what is near absolutely massive support. We've been surviving dips to the 83s and 82s for nearly 8 years now, and the last test came late last year and saw a decent 250 odd pip rally all the way nearly up to the 85 handle. So I'm looking at the low 82s for another try at longs, but this time I'm also going to prepare for a possible reverse or break trade, break short through the 82 level. That's because, as you can see on the chart there, we remain in a 2-year downtrend. And relative to this pair, we've come back down here pretty quickly. It's been several months, but that's quick in euro sterling terms. And there really is a gaping hole underneath this 82 level with very little in the way until we get to the 61.8 fib, the 2015-2020 rally. So I'm looking for longs again on a test of that 82-20 area. But if we do break it, I'm going to be looking for shorts.
Good stuff. Right, this is where we can put the technology and our producer Kyriakos to the test and see whether we can take your questions. We have had a few come in already. Arsenal going to win the league? We're not, certainly not this year. When am I going to win the non-farm payrolls competition? At this rate, Arsenal are going to win the league before that. On a more serious note, we do have something on the Aussie dollar here, Ryan. I'm keen to get your views on this because, of course, tariffs and trade are big influences on the Aussie dollar, particularly that correlation that we see with China. The question is, do you believe the Aussie will recover if China retaliates to some of the US tariffs, potentially if that retaliation is in a way that minimizes the risks of escalation? So presumably, and I'm adding this onto the question myself, thank you for the question, is, we've seen China thus far have gone down the route of antitrust investigations and making things difficult for US corporates, as opposed to necessarily going, well, if you go 20% on us, we're going to go 40% back on you.
Yeah, and Australia's always it's very tied up, obviously, what happens in China. And the Aussie dollar, it hasn't looked particularly strong. We've had decent bounce in it, but as you can see from the chart there that hopefully we've still got on screen. There we go. Look at that magic. We only managed to get to the 38.2 with the drop from the 69s, and we've already undone all of that pretty much in the latter part of last week. China tariffs, is it going to affect Australia? Yes and no. The tariffs in themselves probably won't. The question comes is if Australia's going to be forced to maybe follow the US line and put tariffs on themselves, which they won't want to do. They've just spent the last few years repairing relations with China, opening up their exports again, trying to put a lot of blocks on. And if that happens again, and there was something already, a headline I saw this morning where China wasn't happy with something Australia was doing. If that happens again, then you're going to see the Aussie suffering. Now, if they all get along nicely, then yes, the Aussie has a chance to recover. But as you can see from that chart, these bounces at the moment look very, very dead catchish, and we're not shy in selling off after taking a long time to rally again. And just the last thing I'll mention on that, we do have a lot of these Chinese meetings going on this week, the committee meetings, which Premier Xi is apparently going to announce some stimulus measures. I would not be surprised after the meetings this week if we get a rate cut or a set of rate cuts from China. It was touted in the latter part of last year, particularly the RRR cut. And if they drop one of those, then you will see a reaction in the Aussie dollar, likely to the upside. It may only be a fleeting moment, 30, 40, 50 pips. But if you're in a position after these MPC meetings, be careful. You don't want to be knocked out in your stops on something like that and find the prices right back where it started.
That's a very good point. I would put it to you though that, is that just going to be one massive great buy the rumor, sell the fact? Because I'm sure you remember, as I do, there used to be days, I'm sounding terribly old now, but China would deliver a triple R cut and it would be a 10 basis point cut and the S&P would be up 2% in an instant. And you'd see a comparable and an equal reaction in some of the higher beta currencies. Whereas now it seems very much a case of, I think China's got to the point where they've almost set this impossibly high bar in terms of what the market wants to see, not just from a monetary point of view, but also in terms of fiscal measures to try and turn the economy around ultimately and really complete this transition from a manufacturing focused economy to a services focused one, as most Western nations have undergone. And it's a point where the market's reaction has gone from great stimulus, buy risk, load up, to great stimulus, we want more.
Yeah, absolutely. And that's going to be the market reaction. It's going to be very quick because what's changed with them is that they've been pushing forward. They've been doing forward guidance, if you like. Previously, if they wanted to cut rates, you turned up one morning and see a headline across your screen, and that's the first you know about it. They've touted further cuts in the first quarter of this year. They were doing that in the last 6 months of last year. So the market knows it's going to be coming. This just might be the time it comes. So as I say, for something like Aussie dollar, if you catch the headline, 30, 40, 50 pip move, don't expect that to last. And I hope your positions are taken care of if that does happen.
Indeed, yes. Right. Moving on from that one, good question. The S&P 500, where are we going next? QT in the background and the macro backdrop skittish at best. Let's discuss QT first of all. I've finally managed to get my Bloomberg to work, and hopefully we can have a look at one of my favorite charts because I'm a bit sad, which is bank reserves in the United States. And what we can see here is, forgive me, I'm just looking at the chart myself. This is bank reserves as a percentage of GDP in the United States. I think this is probably, despite Ryan falling asleep over there, one of the most important charts that we can be looking at, certainly in the first half of the year, as the Fed are trying to work out when, and maybe indeed if, to bring the process of balance sheet runoff to an end. Now, what the Fed want to do is ensure that reserves in the banking system in the United States remain ample. Their words, not mine. Now, what you can see in the chart here is we're currently running at around about 11% of GDP. When things got pretty dicey in 2019 and the Fed had to bring quantitative tightening to an end and also start doing some repo operations, to bring things back to a more ample level, these reserves got down to about 6.5% of GDP. When we were in the middle of all of the COVID QE and low rates era in 2021, we got up to about 18%. So the nub of that issue, long and the short, is bank reserves aren't quite as abundant as they were, but the Fed still think that there are enough sloshing around in the system not to be too worried at the moment. The key question is how far will they let this percentage drop before bringing quantitative tightening to an end. Of course, you've got the issue of the debt limit in there as well, but my hunch is that they probably don't want this to go into single figures. If you look at that kind of pre-2019 period, we were generally around the sort of 9 to 11% mark, so not far off where we are at the moment. And the reason why this is important is because if you think about how the Fed acted last year and also towards the back end of 2023, we had what we'd call a Fed put, where if economic conditions worsen, every market participant knows that the Fed are going to come in, they're going to cut rates, they're going to ride to the rescue. You're happy to sit further out the risk curve. You're happy to take on greater exposure as a result of that because Jay Powell and his balance sheet have got your back. Coming into the start of this year, that wasn't necessarily the case because the Fed have gone, we're on the sidelines. There's two-sided risks to the labor market. There's two-sided risks to inflation. We're going to sit here and see how things pan out. So if the economy worsens, there's not this Fed are going to ride to the rescue because they're not convinced they've made enough progress on inflation in order to do that. The reason why this is important is because if the Fed bring quantitative tightening to an end, i.e. stop running down their balance sheet, that removes a degree of liquidity drag from the market. It means the Fed are back buying securities in order to maintain the size of their balance sheet. And that in turn is kind of the resumption of a bit of a comfort blanket for financial market participants to go, okay, maybe lower rates aren't on the card, but at least financial conditions shouldn't tighten too much more significantly. So I think this is a Q2 story, to be completely honest with you. I think probably May is when the Fed bring QT to an end. Until then, I think the market is going to be incredibly choppy. I think the problem we have right now, and I know the S&P is sitting up about 0.5%, is you have a softening economic backdrop and an administration in the White House that is just doubling down on the hawkishness, whether it be on trade, whether it be on geopolitics, whether it be on cutting, supposed government excess. And I think that's a pretty grim combination for the market to be grappling with in the short term, because you've got worsening data and an administration that seems to be saying we don't mind the short-term pain if it gives us a longer-term gain. I think if we can move through that, then the outlook for risk assets becomes considerably more constructive. So the long and the short of it is, for me, path of least resistance leads higher. Does it lead higher in the same linear fashion that it did last year? No, it will be much bumpier. Does it lead higher to the same magnitude that it did last year? No, I think gains will be considerably more capped.
Well said, mate. I don't know much more to add to that. It was very in-depth analysis. Great stuff as always. I look at things pretty simply regards to the S&P. I don't know if Kyriakos can just flick through to the charts, and I'll get my chart up there. Very simplistic chart here. All you need to know, this is the rally from the last couple of years. We're not even close to getting down towards a 38.2 of this. So this pullback we're seeing at the moment, in the grand scheme of things, it's a nothing burger. It's an absolute minor pullback. Are you going to fight that trend at the moment? What we do find, whenever the S&P has a rollover, the market gets all bearish. Oh, it's going back down to 5,000. It's going back down to 4,000, whatever. Okay. As we like to say, the trend is your friend. So, identify your levels where you potentially would look to maybe fight this. But, markets are markets. At some point, something's going to turn around, or you may get a really big dip like we got in, over the COVID times. And it might be possible, but use your fibs and let the levels develop themselves.
Yeah, just leave that chart there 1 second, Kyriakos. This is my question. It's not come from the audience. That 50% retracement, I think this is the cash index you're looking at here, comes in at, what's that, 48.15-ish, as near as makes no difference?
Yeah, 48, which was a huge break point,
Question for you, do we ever trade that level again?
Oh, that's an interesting question. Ever? That's a very, you put me on the spot with that one.
Because I would say no, we don't.
You would say no, we don't. Outside of a big, crash moment or something like that, if you're just talking normal days, no, I don't think we do. I don't think we see that level again.
I would agree. Right, let's. We got a question here about, well, let's call it the Carney Cross, sterling CAD. Where are we heading next? I saw you were knocking up a chart on this a moment ago. I mean, this is like a horrible combination, isn't it? You've got the stagflationary UK economy against the stalling Canadian economy with political risk on the horizon, both in terms of Trump's ire being turned north of the border and an election within the next couple of months. So are we just kind of picking the lesser of two evils here?
Yeah, I think we are at the moment. The pound's got that, starting to get a little bit of that exceptionalism again over the, particularly over Europe. You can see that from euro sterling, as I showed earlier. And this one, yeah, it's got all the makings for a potential break. We've already had a break around that 81 level, 81.5 level. As you can see, I've not got a lot of text on this. I don't look at it all that much, but that was a big old level there. So technically, you can still run with that break. And if we're getting back below that level, then obviously, maybe this moves over and we just had a little bit of excitement above the level. The next level above comes in around that 2018 high, around that 184 area, which is absolutely achievable. We get a no deal with Canada tomorrow with these tariffs. We're probably going to be up there and probably even more. What you need to watch for after is what happens next. Is that the market saying, right, we've got the confirmation of a no deal tariffs. We've done our last bit of selling in the Canadian dollar. Is that then going to see a bit of a top put in? So that's what I'll be looking for in this pair and other Canadian pairs, Canadian dollar pairs as well. So yeah, there's plenty more upside to come potentially for this one, but then you'd have to see what happens after.
Yeah, I think that's actually a really good point, because I would question, and I don't think anyone's actually managed to quite nail this, but we're talking about tariff risk. Is the market, and I'm very much in two minds about this, is the market solely pricing, will there be tariffs, will there not be tariffs? Or is, dollar CAD at 144, 145, wherever we are at the moment, is that also the market pricing the potential macro implications of those tariffs staying in place for the next 12 months? Because I would argue, looking at dollar CAD, if those tariffs go in place and they stay in place 25% for 12 months, I mean, dollar CAD should be somewhere up near 160 rather than 145, if that is indeed the case. So, I think there's, as you kind of put it there, I think there's two stages to this. One is, do the tariffs go in? Do they not go in? The second is, do they then stay in? And if they do, how bad do things end up getting from a growth perspective?
Yeah, I think it's the normal, trading the short term with the medium term with the long term. And all the while you've got to trade the fundamentals that are happening day to day anyway. So yeah, we know that the market, this is still the first, month and a bit of Trump's presidency, since the inauguration. And we're already getting some outside moves. And that's because the market is learning how to trade Trump again. So yeah, 160 in dollar CAD, that's something that happens, or you find yourself a year down the line when there's tons of tariffs on and the economy is starting to buckle and it's starting to pay the costs. And then you wake up and you think, oh, here we are at 160, but it hasn't gone 145, 160 in one swift move. No. It's going to be up and down and up and down and up and down. And I think that's the way you've got to trade it. You've got to take these moments in time, and it's important to know what you're trading at any given moment. Right now, dollar CAD, it's not trading oil, it's not trading what's going on in the dollar, it's not trading yields or US yields or anything like that. It's trading these tariffs, and we're going to get a reaction tomorrow, whether there's a can kick on the deadline, or deal or no deal. And then once we know that part, then the market's going to move on. Because remember, these are just tariffs part one. Then we've got tariffs part two, the reciprocal tariffs that are coming in end of April. Then Trump's thrown around that he's going to probe lumber and everything else. So it's not going to stop after tomorrow. We just move on to another phase, and then the market will just start pricing that again. And then maybe we're up at another range to play with versus the one we've been in recently.
Yeah, no, I think that's a good way to look at it. And actually, that brings me on to what I'll probably make as the last question. It is about crypto, which I can't talk about explicitly, otherwise someone from my compliance team is going to haul me out of this room. But of course, we did have those headlines yesterday where Trump was on his social media network talking about a strategic crypto reserve in the United States. And the way that I would look at that is it's just a nice way to frame what you were just discussing, which is, the market is trying to remember how to trade Trump again. But I think in many ways, trading Trump 2.0 is different to Trump 1.0. And I was talking about this with a client on Friday, because what we're seeing at the moment is an administration that, yes, is moving very, very quickly and making policies that are seemingly incompatible with each other. And those stances are changing incredibly frequently. But I think the big issue for financial markets at the moment is that, if you think back to the first Trump administration, 2017 was tax cuts, 2018 was China, 2019 was we want the Fed to cut rates, 2020 was obviously the pandemic. And actually 5 years ago today, the Fed delivered their first rate cut right at the start of the pandemic. Now, I think the issue for markets this time around is things aren't segmented quite as neatly like that. You've got, let's do Ukraine, let's do trade with China, let's do trade with Canada, let's do trade with Mexico, let's do geopolitics, let's do this, let's do that, let's throw crypto in the mix, let's send out a tweet about Jay Powell and do 15 other things as well. And I think that's really why we see markets struggling to adjust to this environment, because it's not a case of we're trading Trump, there's a lot of headline risk. It's about a known subject. It's we're trading Trump, there's a lot of headline risk. It could be on any subject whatsoever. And I think that's probably why, and feel free to disagree with me, but I think that's why markets are struggling to get their head around and adjust to this environment, even though we're now 5 weeks post-inauguration.
Well, I can tell you I'm struggling, and I know a lot of traders who are struggling as well. Probably since COVID, a lot more politics has been injected into markets. We've had a hell of a lot of elections, coming out of Brexit. We've had these turnarounds in France and everywhere else. And it just seems like there's so much more input coming into trading now. And Trump has just exploded that by a magnitude of 10 or 100. And you can't sit come in the morning, sit down and go, right, I'm going to look at this bit of data, I'm going to look at that fundamental aspect and plan a trade, because all it takes is a truth bomb and whatever you were looking at gets blown out the water, or something happens in Germany and there's an election or vote of confidence, Canada, France, you name. And just at this moment, there are so many plates spinning in the air in terms of input into these markets. It's just making it very difficult to trade, because you can't have a line of thought for longer than 5 minutes at times. So I've shifted to a much shorter term trading strategy. If I get in, if I manage to see some profit, I'm getting out or cutting the position as quick as I can, sticking it in the bank, and then worrying about what happens after. But it is very difficult, and I've been doing this over 30 years, and some of the guys in our chat room the same thing, Blake, as you know, and we're all finding it pretty tough. You get by, you get on, but you have to learn to adjust to it.
Absolutely, and being nimble and agile is the name of the game, isn't it? Right, well, that does bring us to the end of the show. Thank you very much to all of you who've tuned in, to Ryan Littlestone from Forex Live and Forex Analytics, and also to our producer Kyriakos, who has done brilliantly to bring this together on a bank holiday in Cyprus as well. So big shout out to him for turning up and doing that on his day off. We will be back with another recorded, normally scheduled episode of the Trade Off next Tuesday. If you are trading this week, keep it tight. Anything you'd like us to discuss next week, drop a comment below. And who knows, maybe our 200th episode, we'll do another live one. In the meantime, have a good week ahead. Thanks for watching. Goodbye for now.